Okay, here's another question from one of our viewers. Now, David here asks, when is the best time to buy an annuity? Right now, the CD rates are high and the market is doing well. Also, what's the best age and how much should I put in?
That's a loaded question.
Yes.
Well, first, thank you to all of you who watched our channel, posted questions, and called us as well, because these questions will be part of our What the Fact and Mistake series.
Okay, again, he means our frequently asked questions and mistake series.
They know what I mean.
Okay, well, just want to make sure. Back to answering your question, David. Now, have you heard it's too early for you to buy an annuity or just wait and grow your money in the market first? In our other video called Which Annuity is Right for You, we focused on the purpose of the annuity. Now, the word annuity by itself means nothing. Here's a quick clip to show the contradictions if you don't really know what each is designed to do. What is annuity and how does it work?
Well, it provides lifetime income.
No, it doesn't.
It protects your principal.
Actually, that's not true either.
Are you going to keep disagreeing?
Yes.
Okay, well, there are no fees.
There are a lot of fees.
Well, how about this one? You never lock up your money for life.
Actually, your money is gone. You can never touch your principal again. Are you confused?
So watch this video if you haven't, because we will pair the best annuity for the right age. We bought our first fixed index annuity and also MYGA annuities in our mid-20s. But we didn't buy a hybrid pension or a SPIA or a DIA.
Right. And why? Well, the primary purpose of our annuities was to protect the principal. And our secondary purpose was to grow our money better than a CD or a bond. So the ideal age really depends on what type of annuity you should purchase.
Annuities are all tax deferred except for SPIAs and DIAs. So one thing to remember is that the IRS will not allow you to touch the tax-deferred annuities until 59 and a half, or you will have to pay a 10% tax penalty. And this is really why we didn't buy our hybrid pension too early. And if you're in your 20s or 40s, that's probably one of the main reasons why you should wait a little bit longer into your late 40s or 50s.
Yes, that's right. So a MYGA, or a multi-year guaranteed annuity, and an FIA, fixed indexed annuities, they should all be part of your portfolio.
Now notice that she said part, not all. The purpose of this annuity is to grow your principal, yes, but the primary purpose is to not have any market risk.
Right. So don't compare these to your investments. Compare these to your CDs or your bond portfolios.
So yes, from your 20s to 40s, your goal really isn't income replacement, but growth and protection should be your focus. So a MYGA or a FIA, again, multi-year guarantee annuities or fixed index annuities should be part of your portfolio even at that age.
And the only annuities that do not fall under the 59 and a half rule are your SPIAs and your DIAs. But you give up control over your assets and lock up your principal for life.
Now, we have sold those annuities to those under 59 and a half, especially if they for sure want to retire before 60.
If we do a tax-deferred annuity where you keep your principal and have a guaranteed lifetime income, then you cannot avoid the 59 and a half rule. So those annuities, which are called a hybrid pension, are best to purchase in your late 40s or your early 50s. And that's the optimal age to buy if you want to retire early.
And if you're in your 60s or 70s, is it too late to buy a hybrid pension? No. Remember, when it comes to hybrid pensions, it's all about years deferred or years vested, which is much more important than your age. Here's an online calculator to show you what we mean. If you were to put in $500,000 at age 50 and want lifetime income at age 60, you would get $62,728, which is 12.55% lifetime payout of the original principal.
Right. And if you waited until 59 and deferred for just 1 year, you would get $33,205, or 6.64%. Now, that difference of almost 6%, or $30,000 per year for life. If you only lived for 20 years, that's a $600,000 loss of income by delaying to buy a hybrid pension.
Now, most people lived past their 90s, really. So that would be a loss of around $900,000.
That's a lot.
Yeah.
Yes, a guaranteed loss of income. So keep in mind, this is not an interest percentage for life. No one can guarantee you even 2% for
Not even
life.
1%.
No. However, these are all insurance policies which are based on life expectancy, actuaries, and so forth.
So they already mathematically calculated what you would get, so they know that they can afford this payout per year as long as you are breathing. And now, the reason why we say as long as you're still breathing is because sometimes we have viewers that think lifetime income can be taken from their CDs, from their MIGAs, from their investments, and they call this some kind of pension. No, the only thing that can promise you income for life in writing, contractual guarantee until your last breath, is a pension, Social Security, or a hybrid pension. So that's why we like to say as long as you're breathing. Literally, it's not an exaggeration.
Right.
All of these hybrid pension calculations we just discussed are from annuities that are 100% contractual guarantees, not hypothetical maybes.
And of course, you can defer and capture high payouts as well into your 60s, 70s, and even into your 80s. But the earlier you start deferring or vesting, the greater the payout.
And this is why every employer pension, Social Security, SPIA or DIA, or a hybrid pension takes an expert to strategize and maximize the best timing and payout.
Yeah, and this is like getting an expert to give you the best Social Security advice, right?
Yeah, the good example. And regarding strategies, laddering should also be considered. If you split your money into separate policy numbers, you can capture higher payouts by deferring on those accounts and enjoying some income earlier.
And you can also ladder based on when you put the money in and also when you take the money out, right?
Exactly. And if you're confused, we'll be making future videos on laddering. But in the meantime, call us to learn more about laddering and how to maximize your hybrid pension.
Here's a triangle chart to show what type of annuity is most appropriate and for what age. Let's start from the top. If anyone in their 20s to 40s wants to protect their principal and earn interest that is typically better growth than CDs or bonds and tax defer their growth, they should consider MIGAs or fixed index annuities, also called FIAs. The top part of the triangle is money you don't want to lose. While you are younger, having more of your money in the next section might be better.
The middle section is called investments. Since many investments grow faster than most annuities, you may want a larger portion in this section to capture more growth.
However, this still depends on your risk tolerance. If you're not interested in the potential of losing money or cannot stomach it, then it might be better just to buy more of your MIGAs and your FIAs.
Yeah, correct. And as you approach 50, what do you start thinking about, Anne?
Personally, I start thinking about menopause.
Okay.
You mean retirement.
Okay. Anyway, menopause, that's true.
That's what
but
came to my mind first, sorry.
that's inevitable, but retirement is something we can control. And when you think of retirement, not menopause, what are you concerned about? Yes, how do you replace your working income?
Your working income has always been a guaranteed payout through some contract with your employer. If you're self-employed, your payment from your clients were also in writing through invoice.
Now, to Anne's point, you never got paid based on the stock market performance, bond rates, or CD rates, and so forth. Sure, you may have had stock options as a bonus, but not your main salary. If you're paid based on the performance of the market as your so-called salary, would you ever accept that job?
No, of course not. So what type of annuity would best suit someone in their 50s and up? Yes, a hybrid pension. Hybrid pensions have the same guarantee as traditional or SPIAs, guaranteed lifetime income as a payout for life. Yes, not based on how your cash value is growing, not based on the index performance, but rather a guaranteed payout in writing, in a contract, just like you had through your work.
Exactly. Thanks, Anne. So what makes it a hybrid pension is the liquidity and flexibility that traditional pensions don't have. In other words, you can change your mind and cash out, grow your money, and even pass on the remaining cash value to your beneficiaries or estate.
Right. Traditional pensions, you've locked up your money for life once you start them, but not with a hybrid pension. What are hybrid pensions then, and how do they work? Well, we'll show you 2 playlists at the end of this video.
Now let's talk about how much you should put into the annuity. First, as a disclosure, the percentage you should put in depends on your age, total non-liquid assets and liquid assets, retirement and non-retirement money, really your income and expenses and so forth. But most importantly, what are you going to use it for?
In other words, your purpose.
Yes, your purpose is probably the least discussed when you shop for a hybrid pension or shop for annuities. Knowing your purpose will give you the clarity and confidence in how much to put into an annuity or hybrid pensions.
So if you're in your 20s to 40s, your purpose is typically not income planning, rather principal protection and growth. We liken this to a spoon. So we'll call this your principal protection section, safe and simple. Since this is the highest part of your triangle, you would put less than, say, 20% into your high yield savings, CDs, MYGAs, and fixed indexed annuities.
Right, and when she said the highest, you think about the top of the triangle is the smallest portion. So hopefully that helps you remember that. Now, there's no point in comparing the top of the triangle to the next section because the top part has a completely different purpose.
Your investment section should be larger since you have time to take more risks and you're most likely still working. Give or take 80% of your money could be invested in different investments like your real estate, stocks, or your bonds.
Now, we don't mean this 80%, 20% ratio is a hard, fast rule. Don't just jump in and start doing that. There are multiple factors to consider like your risk tolerance and so forth.
Yes, and also, we're not financial advisors that give specific investment advice. We're simply talking in general terms here.
Yes, this only applies if you emotionally, by the way, can handle the risks of the market. That's why we liken this to a knife. As mentioned in our other video, what's the purpose of a knife, Ann?
To cut.
That's right. So why compare investments where the primary purpose is to grow your money, yes, but you have to take risks with them in every one of those vehicles. They're all designed to grow with risks. And that's what your purpose is. Why compare that to vehicles that are designed to protect your principal?
Right. Now let's talk about those coming up to their 50s, 60s, 70s. What is their primary concern as they approach those age groups?
Losing your salary, right?
Right. And here's a crucial point. Your entire life, you built your lifestyle, the type of home you own, your cars, your vacations, based on this last part of your triangle. This is money you use every day. That's why we liken it to a fork.
Or chopsticks.
Yes, your everyday utensil.
Your salary was guaranteed to be paid, as we discussed earlier. So why would you then retire with interest based on the performance of some type of investment that you have no control over?
Right, so how much would you put into a hybrid pension? Well, this part of the triangle is the largest and has always been there to sustain your lifestyle. So first, calculate all your guaranteed income and then figure out what lifestyle you want in your retirement.
Now, please do not make the mistake of calculating your investment income as part of your math. We cannot emphasize enough that the last 30 to 40 years of your working income has never been based on the performance of some investment or some interest rate. Think about when you're working. You were most likely not micromanaging your 401ks or IRAs from work.
Of course, you were still smart about how you spent your money, but you weren't so strict about your spending. However, when most of our clients come to us and are about to retire, they show us a list of things they want to keep and what they need to cut out.
Yeah, remember, Ann, when we had a lady that came to us and her financial advisor had a whole list of things to cut out? And two of the biggest things she did not want to cut out were just simple things, such as Starbucks. And the other one was probably more significant, just gifts during their holidays.
Right, that's unfortunate. Well, what guaranteed income streams would you include then? There are only 3 types: your pension through your work, Social Security, and hybrid pensions.
Now, most of us will only have Social Security. Therefore, having a hybrid pension as the largest part of your portfolio, again, the bottom part of the triangle, will give you the peace of mind you will not have to cut your lifestyle.
So what you would do is carve out some money from the investment section to fund your hybrid pension, usually anywhere from 40% to 60%. Some who have a larger pension through work could use less. Again, the goal is to achieve the stress-free lifestyle you've been waiting for all those years, right?
Now, what money can you use to fund these hybrid pensions? Any source, such as cash from your bank, other annuities, 401ks, IRAs, investment, brokerage accounts, or even selling a real estate property.
Right. Our goal in helping people retire is to give them the promise that their lifestyle will be the same or even better.
Now, investment income does not give you that promise, since you don't know how the stocks will do year to year, or what the CD or MIGA rate will be once it matures.
Only your pensions, Social Security, and hybrid pensions have a promise in writing that your lifestyle won't need to change. And all of these three income streams are the only types that can give you 100% confidence that you can retire early and keep your same lifestyle.
So, talking about age, another thought to consider is the science and math regarding life expectancy. Well, watch this video here where we go into the science and math beyond living longer and happier.
Now, are you still unclear regarding what hybrid pensions are or if investments are still better? Well, then click on this playlist up here.